What's up, guys? Mike here. I've been getting a lot of questions from you guys asking me regarding whether you should be continuously investing during a market crash or you should just wait until this crash is over, the disease is gone, and it's improving, or you should just wait for another crash to come because it looks like it's highly likely we look like we're in a tech bubble that it's about to burst and it's going to go down again. But regardless of all these ideas, I think I have the perfect story for you guys to get you through this market crash that will help you make the best decision for you, because there's a lot of options out there that you could rely on and think on, but the best option is the one that fits for your situation. And to me personally, I think one should always invest consistently no matter how the market is performing, whether the market is continuously going up or it's going to be going down, because over time you should be thinking investing long term for at least 5 to 10 years minimum when you're buying something. And you shouldn't put your money into anything that you do not feel comfortable leaving your money in, because, of course, you all have good judgments. So it's always best to invest and think long term down the road and not to invest for a quick profit, because usually when you invest for a quick profit, it never goes to plan and it actually usually backfires on you. So, with that said, make sure to smash that like button and let's begin. All right, so I found a Reddit username by Jairus Schneid, analyzing the last 40 years of the S&P 500, and he simulated a three investing style, and he found out what is one of the best ways to invest over a 40-year period, and he came up with three different individuals that we are going to go over with. I'm going to leave the links in the description box below so you guys could check them out for yourselves. And with these three people, he found there's different types of investors. One that times the market perfectly, one that doesn't time the market perfectly and is always off and buys at the top, and one who just consistently invests no matter where the market is at, whether it's up or down. She consistently buys and holds for long term. So with that said, let's begin with our three girls that he has come up with in this story, and I think this will make it very clear to you as to which option is going to be the best for you. Okay, so this is a story of how three friends who saved $200 a month and they invested into the S&P 500 index fund, and they tried to time the market. Okay, so that's pretty much what the story is about. Each was saving and investing for 40 plus years from 1979 till 2019, but all three of them had different strategies of when to start investing and jumping into the market. Okay, so we have Tiffany and Brittany, who knew the market could be very volatile and they planned to avoid the crashes. And this is, let's say, what was going on from 1979 to 2019. The war happened. There was a Black Tuesday, the dot-com bubble, the financial crisis in 2008. And each of these girls had a specific feeling that market could go down or could be going really high, and they started investing at different time periods that we are going to go over right now. So over this 40-year period, dumping $200 of income a month, it's going to equal to $96,000 total for over 40 years. And the investment strategy comes up with three different individuals. So we're going to start with Tiffany, the terrible timer. Okay, so pretty much Tiffany is one of the worst timers of the market. She saves $200 a month in her savings account that she earns 3% interest on annually, and she waits to invest for the most perfect moment into the market. But turns out actually that this isn't very good for Tiffany, because she starts saving for 8 years only to put her money in the absolute worst time of the stock market, when it's all the way at the top in 1987, right before Black Monday. And the result was not as a 33% crash on her money, but she never sold. Okay, so pretty much she has never sold her portfolio, and instead she started saving her cash up again, only to do the same thing next three market peaks, which is the next three market crash, always investing at the top right before the market crashes. And every time she just immediately watches her capital go down the drain. And most recently, she put all her money in the day right before the 2007 financial crisis. And she's been saving her cash ever since, again, waiting for the next market peak. So with this perfect bad timing with Tiffany, the terrible timer, Tiffany still didn't do that bad either. Her $96,000 over a 40-year period that she was invested is now worth $663,594. Even though she invested her money at the worst time of the market, her big nest egg still grew thanks to the power of buying and holding for long term. And since then, she has never sold her investment, and pretty much it's always recovered and has done well over time, because it doesn't matter where you really start, because if you think of buying and holding long term, you still will come out ahead. So now let's move on to the next story. Okay, so now we have Brittany, who had the most perfect timing in the world. All the exact same thing as last time we're going to see with Brittany that with Tiffany happened. Instead, because she was also saving her money in a savings account earning 3% interest, but she miraculously timed the market bottom every single four crash all at the same time perfectly, all right, which is absolutely impossible. But she saved up all her cash on those days and invested it and held her money into the index fund in the S&P 500 while saving up again for the next market crash. And it's pretty much overstated how hard it is to predict the market bottom. Okay, in 1990, with the war breaking out in the Middle East, Brittany decided to dump all her cash in the market when it was only down 19%. But in 2007, the market dropped again 19%, and this time she didn't jump in until because she didn't feel like it was already all the way down like last time. And the market again dropped a 56% drop for that time. And again, she perfectly timed the market bottom again. And she dumped all her cash, into the market and waited for the recovery for the market. So I got to be very upfront with you. Predicting the market bottom is pretty much almost impossible to have a perfect market timing. And so let's see how she did. Okay, for her perfect bottom of her $96,000 she invested, her money grew to $956,834 over a 40-year period of dumping all her money at once, collecting $200 a month in a 3% interest and dumping everything at once. It's certainly an insane improvement based on what she's done compared to Tiffany. Brittany has done a lot better, right? But this is not the best strategy, okay? The only difference is a 44% gain, right? But there is a better strategy that I am going to go over with right now, and you'll see exactly why even timing the bottom isn't going to give you the best outcome. All right, so we have slow and steady Sarah, who was pretty much different from her friends. She didn't try to time the market bottom or the peaks, and she didn't watch the stock prices or listen to doomsday predictions that the market was going to crash. In fact, she only did one thing. She opened up her account for investing in 1979 and she set it up to auto invest for her $200 every single month into the S&P 500 index, and she has never looked at her account ever again for 40 years straight, right? She just automatically invests $200 into the index fund at whatever the price is, whether it's up or down, the market is up or down. She doesn't care. Her $200 continuously buys into the S&P 500 for her, regardless of where the market is at. All right, so she invested the first month and the last month of every month in between, and her money never stayed into a high yield savings account for 3% interest, right? So when Sarah was ready to retire, she signed up for an online access to her account because by then, from 1979, the internet was invented in 2019, right? So when she looked at her account, she saw that she has grown her nest egg to $1,386,429. Even though Brittany had the most perfect timing of the market bottom, Sarah still destroyed her by making a $400,000 more return on her capital, not even timing the market, just investing consistently month after month and without ever changing her strategy. So let's recap, all right? All these girls invested $96,000 total over a 40-year period, all right? And they all just bought and held the S&P 500 index and never sold it, right? So Tiffany, the worst timer in the world, all right? She put 96,000 and she came out with 663,000, all right? Brittany, the world's best timer of the market bottom, puts 96,000 and came out with $956,000. And Sarah, the slow and steady, who just invested consistently without ever changing her plan, came to the ahead of all of them and came up with a $1.386 million investment. So if you guys are worried about the market is too high and we're due for another crash, or you want to wait for the inevitable drop before you put your money in, think about how good you really are at predicting the market bottom, and if you can really do it a lot better than Brittany did, who knew to the exact dot of which date would be the best point to invest all her money at once. And even, let's say, even if you want to invest and you're really good at timing the market at its bottom, you still have the losing strategy. Why? Because Sarah still comes out ahead of you. She still executed flawlessly on her plan to just invest continuously without ever looking at it, whether the market is up or down. All right. So this just goes to show you with real data and with real numbers, trying to time the market is nearly impossible. All right. Instead, it's best to just invest consistently and do nothing for a long time, regardless of where the market is at. And sitting there and waiting for a crash may not even ever happen, and you're just worried of something that could not come. All right, so it's best to invest consistently regardless of what's going on and just keep going. Never think about the news. Don't listen to the media because it's just noise. The media is noise, and that's all it is. All right, guys, so look at this. No matter how good you think you are at investing, the best is to invest consistently. Look, Tiffany, the worst, still did better just putting her money. Brittany, the best market bottom timer, still did nowhere near Sarah, the one who invested consistently regardless of where the market was at. So make sure you use a strategy that's best for you. Do you want to come out to be like Tiffany? Do you want to be like Brittany? Or do you want to be Sarah, who invests long-term into the S&P 500, and regardless of what news or noise that came out of the media, all right? Because the media is pretty much just it. noise. They're nothing special and nothing else. So anyways, guys, thanks again for watching my video. I really appreciate it. If you haven't already destroyed that like button, make sure to destroy that like button. Hit that subscribe button, hit that notification bell so YouTube could alert you when my next video comes out. Also, feel free to add me on Instagram. I pretty much post there daily, so if you want to be part of that, make sure to add me on Instagram right away, all right? Also, if you want 2 free stocks from the stock market, WeBull is giving 2 free stocks, one for just signing up to use their platform, and a second stock when you make a deposit of $100 or more, they'll give you a second stock worth up to $1,400. And right now they have a promotion that they're giving 1,200 shares of the Coca-Cola stock. Also, if you want another free stock, Robinhood gives a free stock. Check out the link in the description below for your free stocks. Thanks again for watching my videos, and until next time, make money with Mike.